Well, my gasoline pricing research idea started back when my wife owned a car that knocked on regular and on mid-grade. So I had the choice of either telling her to fill it up with premium gas all the time, which was relatively expensive, or I had to invest some time to figure out how that we were going to be able to continue to buy gas more effectively or efficiently. So I took over her car for several weeks and started experimenting mixing octanes at the pump, trying various mixtures of regular, mid-grade, and premium, and eventually found out that the cheapest way to keep her car from knocking was to mix only the regular and the premium, and that mid-grade wasn't a part of that mixture. The typical octane configuration at a Rocky Mountain gas pump is 85 for the regular, 87 for the mid-grade, and 91 for the premium. Okay, so that is a 2-point octane increase between regular and mid-grade, and a 4-point octane between mid-grade and premium. So you would think that somehow, if you're paying for octane, that the price jump between regular and mid-grade would be less than the price jump between mid-grade and premium, because it's 2 versus 4 in octane. Well, as it turns out, the most pervasive pricing across the United States, and one of the things that we wanted to document, is that the typical pricing grid is 10 cents and 10 cents. So you pay the same amount of money for the first 2 points of octane to get to mid-grade that you pay for the next 4 points of octane to get to premium. We did actually talk to gas stations as well as to executives. The executives didn't seem to want to hide it. In fact, when we called them and talked to them, they basically said, this is just the way the market works. People are willing to pay for convenience, and therefore, why not? Why not charge for it? Well, the economist answer then is a little bit different, which is just because people are willing to pay for something doesn't mean that you can charge it. And that's because competition in the market is supposed to protect consumers from having to pay everything that they're willing to pay. For instance, I don't pay anywhere near as much as I'm willing to pay for broadband internet services because I don't have to. If one party says, we're going to charge you X, my first response is, I'm not going to pay X unless somebody else is charging more than X. So one of the things we needed to do was get some data that involved retail and matched wholesale data. What were the retailers paying at the time they were charging this for wholesale? Did it come from big oil? Because everybody would like to point the finger at big oil. That's where presumably most of the attorneys could make money on lawsuits and FTC actions, etc. And that would have been at the wholesale level. What we discovered is that it's really not at the wholesale level. It really is a retail phenomena. This is where my small business and entrepreneurship side kicks in and says, I need to understand something better about how this market works and how 4 gas stations on 4 corners can actually continue to make high profits off of mid-grade customers and have that not competed away, even though there's free entry and free exit and all the conditions we would normally think of that would be behind basically almost pure competition. But we still see these people saying, well, we're perfectly competitive. What do you think we're doing? Are we colluding? And in that world, economists differentiate between 2 different types of collusion. They have explicit collusion, which is a type of coordinated action where people get together, they discuss it, they have agreements. Think OPEC. And then there's tacit collusion, which is something in the way that the industry is structured, the way that the gasoline stations are positioned, the geographic structure, something else that allows them to not explicitly collude, but to behave in such a manner that they get prices that may look more like collusive prices, like a mispriced mid-grade, but aren't actually an illegal type of collusion. That's where our research agenda turned, to building a model of tacit collusion, where nothing heinous or illegal is going on, but there's a structure of the consumers, a structure of the geographic, in our case, positioning of stations, and the way that the market works that allows for this mispricing in a non-collusive, meaning non-explicit collusive environment. Consumers care because this is a case where you can't just say, you know, the markets are protecting you, competition is strong enough that you can just drive to whatever gasoline station is there and just assume that the mid-grade is fairly priced and it's going to be the best you can do. It's not even usually the best you can do at that station. Now, it's a bit of a hassle. You can just put the premium in first and then add the regular and then jump up and down on your bumper.